Hi guys, welcome to the strategy sessions. So the first strategy that I'm about to mention is that if you have watched the videos about liquidity, order blocks, and fair value gaps, you should be set to go to understand the strategy and how it works. So the strategy did not present itself today, okay? But when it presents itself, it usually provides a very strong momentum in price action. So I will show you a day where that price action happens, okay? So let's go and look at this area, specifically in the zone here, okay? I'll take a screenshot and you can tell me what the price did. And this is what you will see. The same phenomena happens every single time when there's like a reversal trade or something like that. So I'll take the screenshot again, 1 second. So yeah, so I'll zoom in, okay? Just take a second, look at the charts, understand what it's going there. Okay, so I'll start doing the markups, all right? And you guys will have to identify them on your own for the next time, whenever these things happen. So these are the equal highs, okay? The equal highs, I need to extend them all the way to the right. This is the equal high here. Then we have the equal lows, these ones here. Have this equal low, and we have this equal low. Okay? So what I want you to guys identify and spot on immediately is the liquidity. So what is happening is that market is providing an efficiency, right? There's an efficiency that needs to be provided in the markets. So there are a huge amount of sellers bringing the price down all the way here in the form of lower high, lower lows, lower high and lower lows, lower high and then lower lows, okay? So the market is doing that and providing an inefficient market, okay? It's providing an inefficient marketplace. Then in that inefficiency, we should expect the market to reverse in that momentum. So there is an inefficiency here where the liquidity void is present. So price did not trade between this wick, okay? It did not trade from this wick to this wick, leaving this body of a candle unchallenged. So there is no trade challenge. It immediately just sweeps, it goes back up, trades only a little bit through that candle, and over here it just drops and the candle opens and starts trading lower. And in this void, there is we understand there is some sort of liquidity gap, or there is an inefficient trade momentum that has been going, and price is delivering on a short basis at a very huge pace. There's a huge amount of orders pushing the price lower and lower. So what does that create? It creates an imbalance in the markets. So the sellers are delivering more trades and more orders and are heavy on the market than the buyers are. So the buyers are only providing like a quick liquidity, you know? The buyer, if I'm buying here, I'm losing here. If I'm buying here, I'm losing here. Okay? So that's how the price is providing an imbalance. What I want to underlay in this strategy is that you don't want to be part of these trades. Okay? You don't want to be part of them. You will just simply wait, okay? Simply wait the market to deliver down, okay? You don't have any movement here to trade for. And then it goes down, delivers an imbalance. You do not trade this. There is no way to trade this. There's no entry in the market. Maybe in the 5 minutes it can, but it doesn't provide you enough chance to trade this movement downwards. It will take you some time to understand when these trades form and how to trade them. But for now, let's assume that you missed all this trade at the bottom and you're just looking at it. You cannot take a chance to enter. You may say that this is a liquidity sweep, but it did not go piercing through it way enough. It reversed all the way up. It went back down. It provided equal lows, okay? So I want you to focus at equal lows, okay? When price is trading like this, there is an equal low like that is formed, and then price goes trading up into that candle. It closes above it and then provides like an equal low over here. So what we want to see in this momentum is a very strong price action downwards, okay? A very strong price action downwards. So that will be our liquidity sweep that we are searching for, okay? We want to see a very strong price action moving downwards at the equal lows, taking the liquidity. And there is, of course, targets that we will need to identify. Maybe there is a new weekly opening gap high. So if it touches this line, let's say this is a new weekly opening gap high, it will try to reverse off it, because it took, not always, but it took a very strong liquidity sweep here. So we would expect price to drop to the new weekly opening gap high. If it didn't do it and started to reverse the movement, so this is a break of market structure, okay? The movement was going lower high, lower low, lower high, and lower low, okay? So every time it makes a low, it's lower than the low above it. Every time it makes a high, it's a high above this previous high, okay? That's the understanding of lower lows and lower high. So when the structure of this lower low and lower high, if there is a strong movement upward, okay, if there's a strong movement upward taking the previous lower high and challenging the market on a reversal, then what we can expect is that we need to check the fair value gap, the first fair value gap that is present, okay? The first fair value gap, take that fair value gap, okay? If most of the fair value gap is filled and we see a strong order block from that fair value gap, then we may enter the trade, okay? We may enter at the 50% level, okay? That is the safest one. So if you enter at the 50% level, your stop loss will be below these lows, okay? So you'll be risking this much range of the market. If you are worried that the trade might go even further than the fair value gap, so if the fair value gap is completely filled, okay? If the fair value gap is completely filled, then you may raise your stop loss a bit higher, okay? If the fair value gap is filled and it goes sweeps tiny bit below it, okay? However, I advise you to put it below these lows. Why? Because the market is already shifting in structure. It does not want to go to lower prices. So there are times that it can wick through it, and then it can wick through the fair value gap and then continue higher, okay? There are other scenarios where the liquidity sweep will provide you an order block. So how does the order block work? We have this down close candle over here, this down close candle, okay? You see it, this black candle over here, this one here, this exact candle, okay? So this exact candle, it is followed by a strong bullish candle, okay? So it is followed by a strong bullish candle. So this down close candle is forming an order block, okay? If the price failed at the fair value gap and the fair value gap is completely swept, which in my book, it is a liquidity void, okay? It's taking up liquidity. Even if it goes by a wick through it and goes to this order block and moves back upwards, that is a very strong price action, okay? And you can see it as it follows all the way up here. It makes an order block here. In a higher time frame, you might see this order block being filled. So how does this order block work? If you take a series of these three down close candles all together, okay, if you take them all down together as a one bearish candle, you will notice the price is pushing backwards into it, okay? Price is delivering upwards and pushing back into it. So once price delivers, this is called institutional order flow. So in the institutional order flow, they will be filling much orders. You will see a ranging movement, and prices is always moving downwards and swinging back upwards, moving down, swinging back upwards. So the institution is taking orders. It's taking orders here, it's taking orders there, and it's taking orders at this location here. So the institution, what it's doing, it's doing a hedge fund. So they're not putting all their orders here. No, they're distributing it. So they're putting the orders here, and then they wait, send the market upwards. They close the positions, some of them, and then the trade goes downwards here. They add more orders, and then the trade goes up higher. The price consolidates. They add even more trades to take up these highs that we marked, takes up this high. And then the price delivers all the way upwards. Whenever it's taking an old highs, the price should be able to sweep through it, okay? Sometimes the price is not required to sweep, okay? The price is not always required to sweep through it like this. So for example, we are trading here and the price is going downwards. The price is not required to be able to sweep that, okay? So it can take out this high and then just start reversing back downwards to this order block here. And that's where you're gonna get another entry for your longs, seeking even higher highs. So this high here, there's equal highs. You're gonna seek that option for the next trade. So that's an option that could happen, yeah? Or there's another reversal that could happen, is that price will just continue downward momentum, take out this fair value gap, clear out that void, and then even sweep that liquidity gap, this order block that gave us the initial liquidity to go up higher. It will just reverse and continue in a very strong momentum, okay? You should always be able to expect these price actions, and always, whenever the price is delivering through each high, you should take out some of your orders. Give yourself a reward, okay? Reward yourself. Do not wait until all your orders, let's say you're taking 5 contracts over here, and then you passed this high, okay? And you did not remove, let's say, 3 contracts at least. So if you do not remove 3 contracts and the price moves downwards, you're losing 5 contracts movement, okay? But if you take 3 contracts here, at least you have a huge amount of money saved up, and then only those 2 trades that are remaining from this position here are the ones that you may stop there, okay? However, if you take 3 and then 2 here, that's a very good price. You're gonna get a very huge profit, and it's quite insane, all right? So that's how you need to manage your trades. And if you are in a CFD trade, maybe you might have multiple trades set up here, and then you close some of them there and keep the remaining open for the remainder of the day or remainder of the trading session that you are trading, okay? When the price continues of this liquidity sweep and its reversal movement, okay, when it is a very strong reversal movement, price action will not stop, okay? Price action will be continuous, okay? We will not expect this to be a perfect delivery every single time. Sometimes the price will drop back down. Sometimes the price will drop back down from here. Sometimes the price will drop back down here and then continue moving up higher. It will not take this highs at initial, okay? It will drop back down, give us another entry from here at this order block, okay? So let me clear it out. You see this down close candle over here, this down close candle. So that down close candle followed by a huge up close candle, which is a bullish candle, green one. That states that the black candle or the bearish candle is a bullish order block. So price could also come back here and give us a better entry, okay? A better entry here to go up higher. So whenever we are at a liquidity sweep, we do not want to be trading here, okay? We do not want to be trading at a high. We always want to take the best price action here, okay? If you were forced to trade higher at this position here, you need to have your stop loss either here, okay? You will have a very close stop loss because price could swap you out, okay? Swamp you out, take you out of the trade immediately, especially if the market is manipulated. Another thing to be careful about when using this strategy is that as soon as the liquidity is swept, you need to be able to take enough profits. Price is not expected to deliver up to this, let's say TP2, TP1, okay, and TP3. Price is not expected to be going to TP2 and TP3, okay? Take profit 2 and take profit 3. We need to expect at least one of the profit margins, one profit areas are to be swept. Keep it in mind that the price action, as soon as it takes one of these take profits, we're going to expect a huge reversal back from it, a huge drop in liquidity, because that will mean that there's an imbalance in the market. There are traders who are buying here and they're exiting their trades here. So what happens is that the buying momentum, the momentum of buyers, is being disrupted at this location because the buyers are selling their orders. So when they are exiting their orders or selling to make it an exit entry, the sellers will gain momentum, slight momentum, okay, that will push the prices lower. So when that price action is happening, the institutional traders could possibly use this order block to fill in new set of orders to take the price higher. So the price is not always expected to go in this formulation that I'm showing you like that. But if this price keeps continuing going higher and higher, you need to hedge your trade. What I mean by hedge your trade is that in a sense of taking profits. So you bought here, let's say 5 contracts, take out 3, take out 1, take out 1. Okay? This is where you take most of your profits, and this is where you take a single profit. And if it reaches to this one, you'll be covering all your losses if the price goes even down. You're still in profits because your entry is here. So when you're exiting from 3, you're going to have 2 contracts. And you exit 1 here, you're going to have 1 contract remaining from there. So this is still a huge price action all the way up there. So yeah, so always remember, liquidity sweep has to be persistent first, okay? The liquidity sweep has to be taken immediately, okay? And then the price should reverse in a very strong momentum as well. When the price reverses all the way up, we should expect the price to retrace. Through that retracement, we need to already have a trade idea in our head. We have already formulated that the price is going up higher. If the price is going up higher, you need to see this fair value gap traded into, okay? Or it could trade the top of the fair value gap, or it should trade into this order block that is here. Either way, whatever you put your entry, you need to put a very good stop loss, which will be, I will put my stop loss at this lows here, depending on my entry as well. If my account sustains that loss and I do not lose all my money, then I can do that. However, you need to be careful that the price could deliver through that order block and almost touch your stop loss. You need to be very careful that you do not close the trade, accept that the stop loss is being hit, and then sit on the sidelines. Even if the price already delivered and played the same way, you need to accept that you take one trade and that's it. And that one trade will fill you up for a whole day. If the trade works for you during this reversal, you're going to get a very huge momentum. And if you go back to the charts, okay, if you have taken this trade from here all the way to there, you would have gained 31.33, okay, all the way up to 31.95, okay. Let's say you have taken your price, you've taken it here. This is your first stop loss, take profit, I mean. This is your second take profit, and this is your third take profit, okay. When you're using your take profits, do not use the wicks. You should be satisfied by the price being delivered above the candle body. Above the candle bodies. That's a sufficient way of doing it. The candle bodies, all right? So make sure that you're doing the candle bodies. Over here, if we traded at this bottom from 31.36, or let's say for ease of calculation, 31.35, all the way to 31.58, that's where you take 3 profits. If we go and calculate it, okay? If we go and calculate it, let me take the full screenshot now and show you the prices. So you have 31.53. 1 second. You're taking 31.58 and exit on the trade. So 31.35. Okay, that's $23. Okay, $23 here. Once you reach to 31.77, okay, minus 31.35, that's $42. Okay, all the way here, 31.93. Okay, that's $58. Okay, $58 move in the gold. So each $1 move per contract in gold is $100. Okay, it's $100. So if you're taking 5 contracts here, 5 contracts, and you're exiting 3 contracts, 1 contract, and 1 contract here, the total amount of money you are making is as follows. You're making $6,900 here. You're making $4,200 here. And you're making $5,800 here. Okay? So when you exit the trade here, you're taking 3 contracts and you're taking this profit. That's the first one, $6,900. Plus, you're taking $4,200. All right? Plus, you're taking $5,800 when the top meets there. So in total, you are gaining a very safe profit of $16,900. Okay? This is by playing it safe and you're not being greedy to the market. If we say the market drops down and takes up a stop loss, all right, you should put your stop loss at a break even. Okay, you should break even at your entry as soon as the first take profit is taken. All right, put your stop loss at break even. So if the price goes back and takes you at break even, you're still having $6,900 in your pockets. And in that way, you're not losing all your money. So this is my first strategy that I will be teaching you guys. This is the liquidity sweep strategy. Liquidity sweep reversal. All right. And on the next time, I'm going to explain the next strategy, which will constitute around order blocks as well. All right. See you guys next time.